Okay. We have started recording. Stop. So we have this scenario, guys. There is almost similar nicely. So here, because we're looking at future dividends, it's like this. We are going that side. We are going Panopangon. We are going to go down the model, go down growth model. Hold your guards. So now we are actually looking at, because we are looking into the future, looking at the dividends that will come in, the future dividends. So here definitely we will say it will be actually 1 to be the dividends itself, whatever dividend that we have, times 1 over the rate. This is what we are going to have. So how much is the dividends, guys? How much is the dividends? The dividends is 15 cents, isn't it? So it will be 15 cents per annum times 1 divided by, what is the rate? Which is in percentage, which is 0.2, right? This is what we're going to have here. Movita PLC has an issue, $0.5 per share, and has just paid a dividend of 15 cents per share. Dividends are expected to remain constant. Shareholders require a rate of 12% of shareholders required rate of return is 12%. So it is still the same thing that you got yesterday. It will be definitely equals 15 cents times 1 divided by 0.12, giving you 125 cents per share, or $1.25 per share. So this will be the market price, guys. This is the present value at 12%. So I'll do like this because you're looking at future. So this is the present value, PV, at 12% per annum. Right, like this. Hello? Okay? Okay. So, this was example 4, sorry. Here now we are looking at the present value, guys. We're going into the future. So the present value at 12% is 125 cents per share, or $1.25 per share. Okay. We are now going to 5. So we go back to our notes. Is it this? You're worried that I'll die before you are done with your thing, eh? That's a very good worry. That's a very good worry. I'm proud of you. I'll do just that. So we looked at this, guys. So this is the valuation of equity or non-constant dividends. I said, although we can use this model for any future dividend stream, you will only be expected to deal with constant dividends, or more likely the situation where dividends are expected to grow at a constant rate. So you are seeing them to be at constant, or they are actually growing at a constant rate. That is the only way we can use this model that we have used. This is what Martha wanted. This is basically called the Gordon growth model. Wazungu once they do something, they name these things after their family names, whatever. So here now, we'll be looking at the valuation, still the valuation of equity, where we assume that the dividends shall continue growing at a constant rate, Adam. So we have this formula, which is the market value, the current dividend, the dividend that you're getting today. Because you're expecting growth, you factor in that dividend growth, right? Then you go now to the shareholders' required rate of return. So here, the required return, you start now reducing it by the expected rate of growth in dividends, a very intelligent model. Because if your dividends are growing, what is remaining, the shareholders' required rate of return, starts reducing. You want to reduce it. So down there on required rate of return, you are trying to remove the dividends. That is what you are doing. Let's actually try and break it up. You see, Mrs. Selam, if you had started financial modeling, you'll be doing like this. You see? You just come and tear it like this. You just tear it like this, pa. Nailed out. Ask your Mrs. Yame, for free, sure, for free. You can try it. I'll give you this one, I'll give it to you for free. Yeah, you can be in Word, in Excel, in PPT PowerPoint. All you do, like here I'm in Excel. I know I need to make sure that I was this side. This is where I was. I was on a different slide where I want to cut. Then I go back to Excel. Then I go to insert. But we're changing from corporate finance something else. And we're going to insert. Then here there's take a screenshot, but I don't want to take a screenshot. So I'll go to a drop down here. So on the drop down, I'll go to screen clipping. Screen clipping, I'll go like this. Then now I can clip whatever I want to clip. So I'm clipping this. But these things, once you get into, not even modeling, which we and Martha are doing, those are just for the exams. They are not learning a lot of things in there. Yours you learn like so, not so well. You learn about dashboard reporting. You learn about all these important things. When you have the money. I mean, that's an obvious thing, Kyrie. Yeah, it shouldn't be an issue. So when you have the money, you have structured a very good program. Not if these people are just interested in the assignments, not learning. Trust me. No, you guys, you paid. Not you. What is that? There are different bouquets. Adam, there's full bouquet. You paid for Z-World. You paid for Z-World. Z-World. There's a lot to learn in modeling. Are you aware? This world. Ija ninja chito minute to makose to ando muchitako. That's the world. Ija mtambazi world. Ija mtambazi world. Mama mwanzo tamba fubuke. Nzi world. It's just for example. That's the world. There's nothing that is there. Okay. So now, you understand this formula. It's a market value. The very first thing is that you believe that dividends, Adams, is going to continue growing at a structurally defined rate. Hi, Adam. But then, look at how we are getting the market value. We are saying market value equals dividends divided by rate of return. Adams. So we are saying to get the market value per share was dividends divided by a rate of return. So now we have tried to grow this Gordon model. We are actually now putting in the issue of the growth in terms of dividends, because we believe that these dividends will continue growing, but they will grow at a certain rate, defined rate. So now the formula starts getting a bit different, or we start tweaking the formula. So the formula now will be dividends, open bracket, 1 plus the dividend growth, which you have already stated somewhere, close bracket, divided by rate of return minus the dividend growth, because you have to remove that dividend growth. That is how it is. So once you understand the principles behind that, then it becomes very, very easy. Okay. Wait, I'm waiting. First, let's get back. Mother, hold your gun. Let's get back. Let's get back to basics. So first thing, guys, we were actually saying this. So now I'm very manifest. On this model, Yvonne, is that the dividends you expect that the dividends will be growing at a certain rate, which has already been defined. If it's 2%, 5%, the dividends will continue growing by that. If today you get a 10 kwacha and the dividends are growing at 10% per annum, meaning next year you are going to get 11 kwacha, or you will get $11 or 11 cents, whatever. But then, to factor that in your model, we are saying first we came up with a basic formula for dividends. First, we agreed that if, say, dividends, let me even redo what I did yesterday for you to appreciate. We said, if you have 100%, for example, 100% of the value, which is the market value, you have X. This is your market value. The market value of your share, this X. But then you are told that your 0 point, what was the question? Your 0.12 or your 12% gives you dividends of how much? Of 15 cents. These are dividends. Because your dividends, this is basically your dividends. This is basically your interest, your future. This is basically the fruits of your investment. I don't know what is happening here. Okay. So now we are actually saying from this market value, you are able to get a 12%, which 12% is your dividends here, guys. What would be your market value? This is why we did this yesterday. This is why we did this yesterday. This something that you could have hated. I'm not saying you hated it. Something that is possible, and I will not blame you. You could have hated in grade 5. We would do like this. We are saying if 100 equals to x, 12% equals to 15, then to be 100 times 15 equals 12x. So this now, we are saying it will be this 100, because we want to find x, divided by, we used to call it inverse proportion, divided by the 12. This is what we are getting as a 125. Meaning that we know that this 125 market value has given birth to 12% of the return, which in this case is dividends. Right? Now, here we are trying to modify this, which is dividends over rate of return. So we are saying there is a constant dividend growth, and we have been given the rate. So let's factor it in there. But then down, let's remove the dividend growth. So if we come to now example 5, which we are going to do here together. It says Gamma PLC has just paid a dividend of 30 cents per share. Dividends are growing at the rate of 4% per annum. The shareholders required rate of return is 15% per annum. Calculate the market value per share. Please help me to calculate the market value. Even if you make an error, it doesn't matter. I'm just giving 1 minute. Giving 1 minute. 1 minute. So let's do it together. You tell me later if you did the correct thing. First, I would want to know the current dividend. How much is the current dividend? Then I would want to know the dividend growth. What's the percentage? Then I would want to know the return. %. So here now, the market value would be equals the dividend, which is 30, times 1 plus the growth of 4% divided by the return of 15 minus the growth of dividend growth of 4, which gives 283.64 cents, which is basically 284. If I round it off, it's 284 cents. Example 5, yes. The one that was there, the one that I told you to do. How much? What did you get? Who got this? 2.3. 2.8. Yeah. It's once you take it to dollars, 2.8384. Not cents. 283. Yeah. It's 284 if you are using. Yeah. Martha, what did you get? What do you mind? And even when you state this, guys, you assume that it's your X div, right? Your market value X div. You always assume that it's X div if they haven't. Okay. Here it's like this. Oh, you're using Excel, as usual. Okay, that's good. I think, but they'll bring a lot of things, guys, then you'll get confused. Yeah. It is bad. It's very interesting that those modeling which you are doing per Zcash, those things are very basic. But the one that I give, like at corporate, say if if it's corporate, then it means that you deal with data analytics on how to analyze thousands and thousands of data. You deal with the power pivots. You deal with the financial analysis. You deal with the dashboard reporting. Yeah, but what they are doing in my assignments, when their assignments, they come full. And even those assignments, in the industry, we don't even do those simple things that they do. So, Yavo, it's just Z-World. So, Rab, if you have your friends, let's say in Mazabuka, who are in an office where they deal with the Excel, you just tell them that there's corporate, then them now, they'll deal with proper financial modeling. That thing you can't call it financial modeling. That's why I was generous to give it to you at Z-World, right? So let's move on. So we looked at this thing. Remember this formula, guys. Remember this formula. And this formula, it's you don't even need to memorize it. One, it's logical, but secondly, you find it on the last page of your exam paper. Mr. Amema Kalakwe. Let's move on. Yeah. Can you help me on this one, guys? Help me on this one. Mankala wakati guys, manji. It's cold, my friend. It's very cold here where I am. So now, so now guys, the dividend was how much? What was the dividend? 40. Then the growth 6%. Then the return 20. So I'm finding 303 cents. Okay, that's very good. I hope that is what you all got. Market value x div. So we are saying, in practice, it is unlikely that dividends will grow at a constant rate, and that we acknowledge, we know. There are times when dividends will not even grow. There are times when you might not even be given dividends, and we have seen it so many times. However, appreciate that the market value is based on the dividend that the shareholders expect to receive. So as long as the shareholders do not expect any dividends, the market value would definitely plummet, would definitely skydive or nosedive. Shareholders are perhaps more likely to expect an average rate of growth than expect that the dividends will grow at different specific rates each year. So in the examination, you only be expected to do with constant rate of growth, and therefore to use the formula as stated above. Now guys, we have another special example here. So the special example is Omega PLC has just paid a dividend of 20 cents per share. It is intended that the dividend will remain at 20 cents for each of the next 2 years, and thereafter will grow at 4% per year. The shareholders' required rate of return is 15 cents per annum. Calculate the market value per share. Just write this question. It's a very nice question. Just write it somewhere so that we do it together. So what I would want you first do the normal one, the market value, find the market value, the normal market value, the way you actually it was done at first. Just help me do that. Let's pick the information. So just do for the first part. There's something I want to click from here. The first part, yeah. Okay, you have looked at the question, right? Okay, let's do it together. We'll finalize on this part. It says Omega PLC has just paid a dividend of 20 cents per share. It is intended that the dividend will remain at 20 cents per share for each of the next 2 years, and thereafter will grow at 4% per year. The shareholders' required rate of return is 15% per annum. Calculate the market value per share. So, you come here. Clip this. Okay, so here, first, we need to know the dividends currently, which were paid, which is 20 cents. Then we need to know growth, which is 4%. Then we also need to know their rate, which is 15%. So first thing that we need to do is to calculate the market value, which will be equals at time what? Time 2, which will be basically 2 years, which will be equals P, then I pick this 2, so these are things which I will be doing once you buy for the corporate thing. So the market value for this. So for the thing now, here we know already what it is. We know that it is a dividend there times open bracket 1 plus the growth, right? Which is that. Then we say, I can do like this, then divided by 1, or divided by the rate of return minus their growth, which gives us basically 189 cents. Right? That's the market value at time of 2. Where you remember that here the first two, the first years, now up to the second year, the growth here, this is going to remain as is. There will be no growth, because at first what is going to be will be your 20 dividends there divided by rate of return without any growth, which would have been 133 in terms of the market value. You get that? Without growth, if there was no growth, it would be dividend divided by the rate of return, which the market value would have been 133, where they are not expecting any dividend growth. You get it? Now here you have, so we'll say, yeah, must understand one point, that if there was no dividend growth, do you know that the rate was going to be 133? That was going to be the market value. So, but then we are told, yeah, no, so then, but it changes, because you see, these are perceptions of the investors. So the investors, they know that in the first 2 years, obviously, there will be no dividend growth, but after that, the dividend is going to grow at that. So it cannot still be the 133. And this is what we're now trying to do. So here now, what do we do? So what we do, we now need to look at the market value now. So the market value now, first, we need to look at these dividends. I'll do like this. These dividends. So the dividends, we are saying you are going to have 20. Even in second year, you are going to have 20. But then we need to look at the discount factor, which is there. Is it a 15%? Give me the 15%, the discount factor of 15% in year one. It is actually 0.870. In the second year, it is this. Guys, they are, don't get worried. You have what? What do you call it? You will be given tables if you can't do the computations like this. These are just discount factors. There's a table. Ask if you are lost. So the present value of these would be 20 times 0.87. Something like this. These are your dividends. You agreed? Agreed? Then this at time 2. At time 2, what will be the present value of that amount at the present value would be your market value, this 189. The market value at time 2 times your discount rate, discount factor in year 2. So here now, we are going to have something like this. We are going to have 189 times, we discount it in year 2, which is 0.756, because that is in year 2. So you are going to have 143. But then this 143, guys, to find the market value now, will be how much? Will be this. This plus sum of this. You have 175. That will be the market value for this share. Yeah. Yes, Ralph. We're starting from here. So, what we're actually saying, guys, first, First, when we got this 189, here we assumed that the growth will start from year 1 izaendelera socially. Isn't it? So we are saying if we are not told that in the first 2 years dividends will be static, then we are given these numbers here that we are given, the growth, dividend growth, and the rate of return, would find the market value of 189. Another thing, if we are not given the return, it was assumed that there will be no growth rate. It will remain as is. The market value of the share, it was going to be 133. Hello? It was going to be 133, the market value of the share. But that we were told that the first 2 years, we were told that the first 2 years, the dividends will not change, will remain at 20 cents per kilowatt. I'm used to electricity. Will remain at 20 cents per share. Wait, let me explain. What we were told is that the dividends in the first 2 years will remain constant, will remain unchanged, untweaked at 20 cents per share. So, if we were to assume that there wasn't going to be any growth as investors, meaning that the market value was just going to be 133 cents per share. But the story is slightly different. We are told that in the first 2 years it's going to be static. Afterwards, the growth rate, dividend growth rate, will be at 4%. And the return will remain at 15%. So if we just ignore the first statement that we are given, that the dividends in the first 2 years is going to remain static, the market value was actually going to be 189 cents, because we are going to get the 20 cents dividend times grow it at 4% divided by the 15 minus, that is the return, minus the 4%. So, meaning that the market value was going to increase to 189. But then we have been given all this story that the first 2 years, then afterwards it's going to grow at 4% or so. So it changes what the investors will be feeling. So it changes the feeling, the investment feeling of the investors in terms of the appetite that they might have to invest in these shares. Remember that what determines the market value of a share is the dividend growth, it's basically the dividend and the rate of return. So now that we have been given this story, so we are saying the first 2 years we are going to discount the dividends. So the dividend that you are going to get at the end of the year, even if it's 20 cents, it is going to be different from what you would have gotten now. So if we are looking at the market value now, we are discounting all these things and bringing them to today. Meaning, if we are to redo it nicely, it will be from first year, second year, also again second year. First year for the 20 cents, second year for the 20 cents, third year, we will have the market value that we had already calculated, the 189. So this market value in the future, what is it today? So let's do this. Is Martha still there? My bandos are here. I know, guys. Economy, of course. I don't blame her. Economy, of course. So, guys, don't get confused. Let's put this thing in nicely. What is happening? So here we will look at so this will not basically call it the dividends, because I want to also, if I want, we can put dividends like this. Yeah. So the dividends, this 20 dividends that we are going to get at the end of the year, how much is it today? What we are going to get in second year, how much is it today? Adam. Then the market value of this particular share, which we assume that is still ex-div, the market value of the share, again also in the second year, which is how much? Which is 189. Do it in this way, then you won't have problems. Then here, when you operate financial reporting at 11, so let's finalize this. So, meaning that the amount here will be this. So instead of putting actually this will be so amateurish. Let me do this. I put it here. So these are cash flows. Then here now we have the discount factor at 15%. So we are saying in the first year at 15% equals to what? When you check in your thing there, it is 1.15 equals to this. Then in the second year, it is 1.15 this. So that we don't get confused. Maybe at first I didn't explain it in this way. So meaning that the present value, we are looking at today, guys. The present value would be the cash flows there times this. These are what you'd call cash flows. So you have this there like that. So meaning your NPV, your net present value of this particular share will be equals sum these numbers, which is 175. So this 175 now becomes your market value. So your market value as at today, market value now, like we are calling it, if you go on your stock market, we are saying the market value of this particular transaction is 175. Has it been explained differently and better? I'm asking first before you check my screen. Adam. At first, maybe this was a street explanation because I assumed that you knew. But the whole story is this one here. So guys, are you done writing? Aripo is just a Massa who is not there. I understand the struggles, so it's I wish you all the best. Because this online thing, guys, you should be loading bundles in time, man. You'll be missing classes. I know the struggle is real, but you load. Those that are using Airtel, even in car is better. Because you just go quiet. Yeah, no, the struggle is real. I know you call Arab so that you hear, but I know my predictions are never. I don't miss on my predictions. In terms of predictions, I'm very good. Which one? No, it's this 189. This 189 in year 2, Adam. In year 2, the discount rate of 0.756, meaning that this market value here to now is 143. But then remember that now this one becomes more or less like you're bringing in the camp div thing. You have factored in dividends. So the dividends that you're going to get, these are the dividends that you get, right? So these dividends, you add them to your present value of that market value. Thank you. So I don't know what time we'll meet tomorrow, guys. So I'm going to advanced financial reporting. I'll be looking at group cash flows. I like group cash flows for some reason. I just like that topic. So I don't know what time. Yes, tomorrow is Sunday, but don't think of going to church. Mr. Lusambo will fish you out like I don't know, and you'll be on camera. You're running around in church because he moves around with the camera. So please don't go to church. I don't want to see you. I don't want to see you on social media, Mrs. Siam. I don't want to see you on social media. Yeah, 12 is fair. 12 is fair for me. Maybe I can even sleep a bit. 12 is fair. Yeah, 12 hours. Okay. But please pray at home. I know that is just my personal view. Pray at home. Seeing you running around on social media, on Facebook, that would be very embarrassing. Please. Okay, thank you so much. Bye.